it's today again. Welcome back to Joseph's Reserves. I'm Joseph and I store 20% of my income in the form of rare coins and precious metals. Every week I break down what happened in the precious metals market, why prices are moving that way, and what I'm personally watching and seeing as someone who works in a coin shop and a long-term stacker. This week was another difficult week for precious metals. Every major metal closed lower, but honestly, I don't think that's the big story. The biggest story is almost every long-term reason to own precious metals is still here, and yet prices continue to drift lower. So that leaves us with one very important question. If every long-term fundamental is still incredibly bullish, why are precious metals still falling? And that's exactly what we're going to cover today. Congratulations to South Haven Coins and Bullion for getting to my comment section in my last video first. Racing to the comment section is actually a really great way that you can support my channel, so thank you so much for your continual support. Let's start with this week's actual performance. Gold closed at $4,017.31, which is a 2.5% drop from last week's close. Silver closed at $55.90, which is a much steeper 6.6% decline from last week's close. Platinum closed at $1,585, which is down 2.1% from last week. Palladium closed at $1,232, which is a 2.2% decline from last week. And finally, copper closed at $6.30.1, barely moving overall at a 0.07% decline. If we rank these in terms of performance, the largest movement was silver at 6.6%, then gold at 2.5%, palladium at 2.2%, and then platinum at 2.1%, and of course copper essentially being unchanged with only a 0.07% decline. As for me, I've continued buying precious metals every single week, and it's not that I'm hugely bullish right now. In fact, I've actually been saying that we might turn around at $55 silver for quite a few months. Now, could we see $50 silver? Absolutely. Markets have a way of overshooting in both directions. But here's what has me scratching my head. Almost every long-term fundamental that originally convicted me into owning precious metals is still strongly intact. Nothing has fundamentally changed, so why are prices still moving lower? To answer that, I think we have to separate the market into two completely different forces: the long-term investment thesis and the short-term trading environment. So let's begin with the long-term picture. One of the reasons I remain strongly optimistic is that central banks around the world continue adding to their gold reserves. They're not buying gold because they think it'll go up next Tuesday. They're buying it because they're planning decades into the future. Central banks understand something that individual investors often forget. Gold isn't simply just another investment. Gold is a monetary asset, a financial insurance. When countries diversify reserves away from relying entirely on paper assets, gold is usually one of the first places they turn, and that trend has not changed. Alongside central bank buying, we're still seeing countries gradually diversifying away from relying exclusively on the US dollar for an international trade. Now, let me be clear about this. The dollar remains the world's dominant reserve currency. I'm not arguing otherwise, but many nations are expanding bilateral trade agreements and using local currencies while simultaneously increasing their gold reserves. And that trend has been building for decades. It hasn't suddenly disappeared because metals corrected a few weeks. Another long-term fundamental is debt. Government debt around the world continues climbing. History has shown us that excessive debt eventually forces difficult monetary decisions, whether that's higher inflation, currency debasement, lower real interest rates, or increasing money creation. Hard assets have historically benefited over long periods, and that hasn't changed either. Another long term fundamental is inflation. Inflation has certainly cooled over the last year, but let's be honest, nothing has gotten cheaper. Prices remain significantly higher than they were just a year ago. Most households are still feeling the effects of buying groceries, filling their gas tanks, and paying their monthly bills. Long term inflation concerns remain very much alive. The next point is geopolitical uncertainty. There's still a whole lot of geopolitical uncertainty around Russia and Ukraine and the Middle East. And normally, geopolitical uncertainty is considered one of the strongest bullish catalysts for gold. So, especially with the war in Iran, it seems like it's just not working this time. Well, it's really because this conflict is directly involving the United States. And several countries involved are major energy producers. With sanctions, reduced exports, and pressure on oil reserves, some governments need liquidity. And one way to raise that liquidity is by selling reserves assets, like gold. In other words, gold is doing what it's supposed to. It's providing that financial flexibility during times of stress. And ironically, that can create a temporary selling pressure, even though the underlying reason that people own gold is actually becoming stronger. So I don't see that as gold failing. I see it as gold successfully performing one of its most important jobs. The last thing I want to touch on here is the industrial demand. Really, nothing has changed. Demand continues to grow. Silver remains critical for solar panels, electrical grid expansion, electric vehicles, consumer electronics, and medical technologies. And if anything, artificial intelligence has only accelerated the demand. Every new AI data center requires enormous amounts of electricity, and that means more transformers, more switch gears, more electrical infrastructure, more cooling systems, more wires, all of which require a tremendous amount of silver and copper. Copper, in particular, remains one of the world's most important industrial metals. Every transmission line, every charging station, every substation, every transformer, every data center, every AI facility will require massive amounts of copper. And now let's talk about platinum and palladium. A lot of people assume that because electric vehicles don't use traditional automotive catalytic converters, that demand for these platinum group metals will simply disappear. But it's really not that simple at all. Yes, switching to electric vehicles will reduce the demand for gasoline vehicles, but electrification also requires enormous increases in power generation, industrial processing, hydrogen production, backup generators, chemical manufacturing, and emission control technologies. Then, when you add AI data centers on top of that, those facilities will consume a staggering amount of electricity, which means more infrastructure, more industrial equipment, and greater overall energy demand. The sources of demand may evolve, but that doesn't automatically mean that total demand disappears. In many cases, it simply shifts, and that's why I still believe in the long-term industrial story of these metals remaining very compelling. So, if all of these long term fundamentals are still working in favor of precious metals, why are the prices still falling? The answer lies in the short term forces driving the market today. Really, it's that the market doesn't trade fundamentals. They trade expectations, they trade emotion, they trade liquidity, and sometimes they simply just trade momentum. Right now, I think the market is being driven by much more short-term forces than long-term forces. So let's talk about those. The first headwind is the Federal Reserve. Even though inflation has come down from its heights, investors are still trying to figure out what the Fed is going to do next. Every speech, every jobs report, every inflation report, every GDP estimate, the market immediately asks the questions, what does that mean for interest rates? If investors believe rates are going to stay higher for longer, that generally creates pressure on the precious metals. Gold and silver don't pay interest. So, when treasury yields are high, many investors temporarily move money into interest bearing assets instead. Now, I don't think that changes the long term investment thesis, but it absolutely affects the short term pricing. Another major headwind is the US dollar index, also known as the DXY. This is something that gets misunderstood all the time. When people hear that the dollar is getting stronger, they often assume that that means purchasing power of the dollar is increasing, but that's not necessarily true. The DXY doesn't measure the dollar against gold, it measures the dollar against inflation. It doesn't measure the dollar against groceries or housing, it simply measures the dollar relative to the basket of other fiat currencies, including the euro, the Japanese yen, British pound, Canadian dollar, the Swedish krona, and the Swiss franc. So here's the important part. Even if the dollar is slowly losing purchasing power, if those other currencies are losing purchasing power faster, then the DXY actually rises. In other words, the dollar can become stronger simply because the rest of the world's fiat currencies are weakening more quickly. Since gold is priced internationally in US dollars, a stronger DXY often creates a short-term downward pressure on the precious metals. Again, that's a relative currency story, not necessarily a story about the dollar becoming fundamentally sound. Another factor is simply technical selling. Gold and silver had tremendous rallies over the past year, and after moves like that, large institutional investors often take profits. Momentum traders begin selling, algorithmic trading systems trigger, support levels break, and more selling follows. That doesn't necessarily mean that the long-term trend has changed. Sometimes it simply is the market catching its breath after enormous runs. Corrections are uncomfortable, but they're also normal. And speaking of sell-offs, I want to talk a little bit about some countries that are selling gold. Some countries around the world have seen pressure on their export revenues. If a country suddenly earns less from selling oil, you still have government budgets to fund, you still have imports to pay, you still need liquidity. And that's the reason that reserve assets like gold exist. Gold is one of the few universally accepted assets that can be sold almost anywhere around the world. So, in periods of financial stress, governments and institutions sell their gold to raise cash. Ironically, I don't see that as a gold failure. It's really proof that gold is doing exactly what it's supposed to. When times get difficult, gold provides liquidity. That's the reason that central banks continue buying thousands of tons of it, and really why stackers like us choose to buy what we can when we can. But I think one of the biggest reasons prices continue to drift lower, even though it feels like it should be turning around right now, is that people are waiting. Not only just people, but large investors and industries are waiting. They're not necessarily bearish, they're just cautious. Everyone wants to buy right now, but no one wants to buy too early. Everyone wants that confirmation that the bottom is already behind us, and that's completely understandable. The problem is that the market's not just going to ring a bell when the bottom arrives. By the time everyone feels comfortable buying again, prices are going to be much higher. One thing I've noticed over the past several months is that traffic inside of our shop has definitely slowed. Not because people suddenly stopped buying or believing in the precious metals, actually it's almost the opposite. The people that do come in are asking lots of questions, they're checking the prices, they're telling us they're planning on buying, but many of them are just waiting. They're hoping for one more drop, or they're waiting for a confirmation that the correction is over. It seems like an excitement has temporarily left the market, but not the conviction. Personally, I think that if silver starts moving back to $60, or especially if it starts pushing back to $65, we'll see a lot of those buyers rushing back in. The human nature hasn't changed. What gets me laughing about it is it's 55 right now, so why wait until it's 60 or 65? But really, just like any other time, they're waiting to see the signal that is moving back upward. I think the event that this week perfectly illustrates the mindset of stackers and buyers right now is that the U.S. Mint released its Liberty Bell commemoratives. There was a half-ounce silver medal that was priced at $750, a half-ounce gold coin that sold for just over $10,000, and a 1-ounce gold coin that sold for $19,600. The thing is that all of them sold out immediately within the first minute of release. All 2026 issues of all three Liberty Bell commemoratives completely sold out. So let's think about that for a moment. Many investors say that they're waiting to buy bullion because they're hoping prices will rise or hoping that prices will fall a few more dollars so they can buy it lower. Yet collectors had no hesitation spending thousands or even nearly $20,000 on a single product. To me, that says that demand hasn't disappeared at all. If anything, people are storing up their cash so that when they do see the signals they're wanting, they're going to buy big. So, what am I doing? Honestly, nothing has changed. I'm still dollar cost averaging. I've said for a few months that I thought the bottom would be around $55 silver, and it does still look like a very attractive area. We could see $50, but I'm not going to be waiting for it. I wouldn't be surprised at all if we saw $50, honestly. Maybe we will and maybe we won't. But the truth is, since I have no idea where the exact bottom is, and neither does anyone else, that's why I don't build my investment strategy around predicting the bottoms. I build it around buying value. Because I've learned something over the past couple years is that I don't try to buy at the lowest price, I just try to buy at a good price. And if I can consistently buy at good prices over many years, I don't need to perfectly time the bottom. As I look at today's market, I can't help but to think of a slingshot. These long-term fundamentals are like the elastics ready to shoot prices in an upward direction. Central bank buying, growing industrial demand, government debt, inflation concerns, geopolitical uncertainty, but at the very same time, these short term pressures keep pulling the slingshot back further and further and holding it longer and longer. These higher interest rates, the stronger DXY, technical selling, these profit takings, and investors waiting for this confirmation. Every week, those forces are pulling against each other just a little bit more and more. And it's almost like pulling the slingshot back further so that when that potential energy gets released, we will surely see the prices move. Does that guarantee anything? No. Markets aren't guaranteed. But I do believe the longer this tension builds, the more significant the eventual move will likely be. If you enjoyed today's market update, please like the video and consider subscribing. Let me know down in the comments, what do you think is driving this correction? Is it simply a healthy pause of a long-term bull market, or do you think something bigger is happening? I'd love to hear your thoughts. To my long-term subscribers, thank you so much for your continual support, and make sure you go to josephsreserves.com to check out my merchandise, coffee mugs, my zip-up bags, and of course the It's Today Again coffee. But most of all, thank you so much for watching, and just remember, every ounce adds up, so no matter how small, just keep stacking.